What if your next $100 investment could be the smartest one you ever make? Not on a lottery ticket, but on a real, overlooked company? A market has been red hot, making those obvious cheap opportunities feel like they vanished. Today, we're hunting for exactly that. 3 specific stocks, all trading under $100 a share, that the crowd might be ignoring. I'm going to put each one through a rigorous financial inspection. Do they have genuine growth ahead? Are they producing real cash? And the ultimate question, is the current price a trap or a treasure? First, some context. We've seen a historic market run. A correction, then a powerful rebound, and now new highs. But here's the quiet truth nobody shouts about. This rally has been narrow, powered by a handful of giant names. Meanwhile, several strong, growing companies have been left in the shadows, still trading at sensible valuations. That's our sweet spot. We want solid fundamentals, real business momentum, and that critical final ingredient, a reasonable price tag. Now, a quick vital lesson. The share price alone is meaningless. A $600,000 Berkshire Hathaway share can be cheaper than a $200 Tesla share. It's about what you get for your money. Recently, a popular financial site suggested 3 no-brainer growth stocks to buy with $100. We're not here to blindly follow headlines. We're here to dissect them, learn, and see if there's any real substance behind the hype. Their picks? Marvell Technology, DraftKings, and Uber. Let's see if they pass our test. First up, Marvell Technology. Ticker MRVL, around $87 per share. But the important number? Market cap, $73 billion. That's the total price tag for the whole company. Enterprise value is slightly higher at $78 billion, meaning they have about $5 billion in net debt. Good news, they generated $1.6 billion in free cash flow last year. That means they could wipe out that debt in about 3 years. Impressive. But here's a yellow flag. Their return on capital is low. This measures how efficiently a company uses its money to generate profits. Higher is better. Marvell is becoming a key, quieter player in AI, making specialized chips for data center networking used by Microsoft and Amazon. They re-guiding toward $10 billion in revenue by 2026. They also acquired a company called Celestial AI to boost their optical tech, which could add $1 billion in sales within a few years. Sounds promising, right? But is the stock price reasonable for all this potential? Let's dig into the history, because it's eye-opening. Their 10-year average profit margin? Just 3.7%. Their 5-year average? Basically zero. Last year's margin spiked to 32%. That's a massive jump. The crucial question is this a new permanent level of profitability or a temporary peak? This company has been public since 2000. Can you bank on this high margin continuing? That's the multi-billion-dollar question. Gross profit is strong, over 50%, which is excellent for a chip designer. Revenue growth has been decent. They haven't grown wildly through expensive acquisitions, which I like. But if this feels like a lot of numbers, you're right. It can be overwhelming. Every great investor, from Buffett on down, started exactly where you are. The key is having a clear framework to make sense of it all. So let's apply our framework. The 8 pillars give us a health check. For Marvell, it's a mixed bag. 4 passes, 4 fails. We see revenue growth, profit growth, and cash flow growth, which are good. Their profit and cash flow have risen in line with sales recently, suggesting that maybe a 20% margin is sustainable, not last year's 32%. Analysts are bullish, projecting revenue to triple in 5 years. That's huge growth. I plugged my assumptions into our valuation model. For a 10-year forecast, I used revenue growth of 8%, 12%, and 16%. For profit margins, I used a more cautious 15%, 20%, and 25%, aligning with their recent cash flow conversion. For the future PE ratio, I used 13, 16, and 19, reflecting their mediocre returns on capital, but good industry position. I hit Analyze. The result? A low price target of $28, a high of $108, and a middle target of $56. With the stock at $87, my middle scenario suggests only a 4% annualized return. Most investors lose money by chasing winners. The real secret is avoiding the obvious losers. A fantastic story ruins your portfolio if you overpay. We grabbed you with an interesting title, but our mission is to teach you this protective process. Let's move to our second contender, DraftKings. I'm not a big gambler, but I get the appeal. This is an $18 billion business leading the online sports betting charge. Despite new regulations and rivals, user engagement is strong. A surge in complex parlay bets, which are great for the house, is boosting their profits. Big deals with media giants like NBC and ESPN are expanding their reach. Crucially, they're starting to cut their massive marketing spending, which could really help the bottom line. Financially, they generated $530 million in free cash flow last year, which is positive and a big turnaround from years of losses. They have modest debt. Revenue growth has been explosive, 67% annually over 5 years. But here is a concerning trend. Their gross margin, the cut they keep from each bet, has been falling steadily, from over 80% years ago to about 39% now. As that margin shrinks, future profits get squeezed. The 8 pillars look ugly, but that's expected for a hyper-growth company burning cash early on. Analyst estimates are optimistic. They see earnings soaring from 27 cents per share this year to $4 in 5 years. If that happens and the stock is a 20x PE, it could be an $80 stock more than double from today as $35. But that is a giant if into the valuation model we go. For DraftKings, I assumed 8%, 12%, and 16% revenue growth for the next decade. For profit margins, I used 10%, 16%, and 22%. For the future PE, I used 15, 20, and 25. My analysis spit out a low target of $25, a high of $143, and a middle target of $64. Sounds good, right? But there's a major caveat. Look at their share count history. It's been diluted significantly. If a company keeps selling new shares to raise money, your ownership gets watered down. Even if the business doubles, you might not see the gain. For companies like this, you need an extra large margin of safety in your price. Hope is not a strategy. I used to buy stocks on hype and pray they'd go up. It was stressful and unreliable. I built a system for myself, tools that replace fear with clarity, so I could sleep at night. That system became Winds of Thought. It's about using numbers, not emotions, to make decisions that protect your capital first. Try our methods, and you might find that confidence replaces your anxiety. Finally, the third company, Uber. It's more than an app. It's a verb. They command a staggering 76% of the U.S. ride-hailing market. User growth is strong. Trips are up over 20%. That's the magic of operating leverage. They're also positioning themselves in the future of mobility with autonomous vehicle partnerships. Notably, investing legend Bill Ackman took a massive $2 billion position in Uber this year. Financially, it's a $174 billion company now focused on cash, generating $8.7 billion in free cash flow last year. Their 8 pillars are also a mess, again typical for a company that prioritized growth over profits for years. But the story is changing. Analysts see steady, not spectacular, growth. Earnings roughly doubling over the next 4 years with solid revenue increases. So, what's it worth? I last analyzed them with these assumptions: 6%, 9%, and 14% revenue growth. Profit margins of 18%, 22%, and 26%. And future PEs of 18, 22, and 26. The result was striking. Low target, $90. High target, $316. Middle target, $160. With the stock around $80. That middle scenario implies an 18.5% annualized return potential. That's a number that demands a second, very careful look. So, we've analyzed 3 intriguing sub-$100 stocks. Marvell showed potential, but currently looks fully priced. DraftKings has a high growth path, but carries dilution and margin risk. Uber, surprisingly, presented the most compelling valuation case based on my model. The lesson here transcends any single ticker. The market doesn't reward what you know. It rewards the price you paid for knowing it. Your greatest edge isn't finding the next big thing. It's paying a sane price for a good thing. If this process of peeling back the hype and analyzing the core numbers resonates with you, you're in the right place. This is what we do at Ones of Thought. If this deep dive helped you, please like the video. It supports our channel and helps us find more viewers like you. And tell me below, which of these 3 companies are you most skeptical about, and why? But what if you could generate consistent income from stocks you already own without selling them? There's a strategic method for that, and it's changed how many of our community members invest. To see how it works, click the video on screen now. I'll see you in the next one.